Okay, so get this. We're diving into the world of energy today, and specifically a company that's making waves.
Waves, huh?
Yeah, big ones, potentially. You guys sent over some info on EOG Resources, and let me tell you, this one's intriguing.
Intriguing, okay. Why is that?
Well, they're sitting on a potential gold mine, the Utica Shale. Think of it like this.
Like what?
Remember a few years back when everyone was talking about the Permian Basin?
Oh, yeah.
Everyone thought it was the be-all and end-all of oil and gas?
Yeah. Yeah, it was crazy.
Well, EOG's early success in the Utica is giving off some serious Permian vibes.
Interesting. So we talking like boom times for EOG.
Potentially, yeah. They're seeing really promising production numbers from their Utica wells, comparable even to some of the high-performing zones in the Permian.
I do like to hear that.
Right, and they're projecting some serious output increases over the next few years.
Okay, gotta ask though, impressive as that sounds, what does it actually mean for someone eyeing their stock?
It means, potentially, they've got a source of high-margin production locked in for years to come. And you know how the energy market is.
Volatile, up, down.
Exactly.
Yeah.
So that kind of longevity, it's a big deal.
Stability, yeah, I see what you're saying.
But look, it's not just about this one new venture. They've got a solid foundation. 8 consecutive years of positive free cash flow.
Okay, now that is impressive. That's not easy to do.
Right. It says a lot about their management, their business model.
Resilience, for sure.
Yeah.
They've weathered those oil price swings better than many.
Exactly. And here's the thing. They're not hoarding all that cash. I saw something about dividends.
Oh, yeah, EOG is pretty investor-friendly when it comes to that.
Like, what do we need to know about their dividend history?
They've got a good track record of paying dividends consistently. And not just your standard ones either. They've done special dividends, share buybacks.
Hold up, share buyback.
Yeah, which usually means they think their stock is undervalued. A good sign, potentially, for someone looking to invest.
That's really interesting. They're basically putting their money where their mouth is.
Exactly, reinvesting in themselves.
But they're not just laser focused on one region, right? Tell me about that.
You're right. They've got a pretty diverse portfolio of assets. Like you said, not putting all their eggs in one basket. Smart move in this market.
Spreads the risk, makes them more adaptable. But what else sets them apart?
One word. Premium drilling.
Premium drilling.
Yeah, they're known for it. Basically, it means they use the latest and greatest tech to get the most out of every, well, as efficiently as possible.
So higher profits.
Exactly. Higher efficiency, higher profits.
And they're not afraid to set ambitious goals. They've got this benchmark of $40 a barrel for oil and $2.50 for natural gas.
Ambitious, but that tells you they're serious about profitability. Every project has to meet that standard.
That's a good point. No half measures.
Exactly.
Yeah.
And then there's their strategic move into the southeast U.S.
Right, I read about that. What's the significance of that move?
They're securing pipeline capacity. They're thinking ahead.
So they can actually get their product to market, no problem.
Precisely. Building the infrastructure to support their growth. Remember those lemonade stands we talked about?
Right. Got to have enough roads to deliver all that lemonade.
Chuckles, exactly. And don't forget their Brent-linked gas sales agreement.
Ah, yeah. What was that about again?
So instead of just relying on the U.S. gas market, which can be a bit unpredictable, they've linked their gas prices to the international Brent benchmark.
Smart. They're playing the global game.
Exactly. Potentially securing higher profits that way.
Okay, that's really interesting. But what about everyone's least favorite topic, cost control? With inflation the way it is.
Oh, EOG is on top of it. They've got these things called artificial lift optimizers. Basically, they automatically adjust well output to maximize efficiency.
So less waste, more savings.
Exactly. Plus, they've locked in service costs in advance. Smart move considering potential price hikes.
Oh, wow. So they're thinking long-term on that front.
Oh, yeah. They're also investing in infrastructure like that Janus gas processing plant.
And that's going to...
Lower operating costs, boost profits. It's a long-term strategy.
It really seems like they've got it all figured out.
They're definitely doing a lot of things right.
So to recap, we've got strong financials, diversified assets, strategic expansion, commitment to efficiency, and those promising developments in the Utica Shale. Sounds like EOG has a bright future, maybe.
They do have a lot going for them, but as with any investment, it comes down to this. Will all of this translate into stock price growth? Something to think about, do your own research. That's the fun part.
Yeah, exactly. Thanks for breaking it down.
Anytime.